Welcome to Invest Giant. Learn, invest, build your net worth. Today we're diving into the top 5 best high-yield dividend ETFs for 2025. If you're looking to maximize your returns and secure a steady income, this video is for you. Now before we get started, remember this is not financial advice. Do your own research and consult with a professional before making any investment decisions. With that being said, let's get started. Alright, kicking off our list at number 1, we have the Spider Portfolio S&P 500 High-Dividend ETF, also known as SPY-D. It tracks the S&P High Yield Dividend Aristocrats Index, which includes 80 of the highest dividend-paying companies within the S&P 500. These are established companies with a long history of paying and increasing their dividends. SPY-D offers a high dividend yield of around 4.3%, significantly higher than the average S&P 500 yield. This means a $10,000 investment could potentially earn $430 per year in dividends alone. The trade-off with a high dividend yield is often lower growth potential, but SPY-D focuses on companies with a proven track record of dividend growth. This means your income stream has the potential to increase over time. By investing in 80 different companies across various sectors, you're spreading your risk. SPY-D has a low expense ratio of just 0.07%, meaning you only pay $7 in fees for every $10,000 invested. So if you're looking for a high-yield dividend ETF with a proven track record, diversification, and a low expense ratio, SPY-D is worth considering. It's a solid foundation for dividend growth. Let's move on to the next ETF. Moving on to our second ETF, we have the Vanguard Real Estate ETF, ticker symbol VNQ. VNQ tracks the MSCI US Investable Market Real Estate 25/50ths Index, which includes REITs involved in various property sectors. This diversification within the real estate sector helps to mitigate risk and provide more stable returns. Historically, real estate has provided competitive returns compared to the stock market, especially with rental income reflected in the ETF's dividends. VNQ currently boasts an attractive dividend yield of around 3.9%. This means a $10,000 investment could potentially generate $390 per year in passive income. With an expense ratio of just 0.12%, you're only paying $12 annually for every $10,000 invested. Real estate comes with its own set of risks, but the diversification and potential for high returns that VNQ offers outweigh these risks. If you're looking to add real estate exposure to your portfolio, generate passive income, and keep your investment costs low, VNQ is worth exploring. Let's check out the next ETF. Now let's move on to number 3 on our list, the Hoya Capital High Dividend Yield ETF, or RIET. This ETF focuses specifically on REITs, offering a targeted approach to real estate investing with a focus on generating high dividend income. One standout feature of RIET is its monthly dividend payout. Instead of receiving dividends quarterly, RIET distributes its dividends every month. This can be a game changer for investors who rely on dividend income for living expenses. RIET boasts an impressive dividend yield of around 7.5%. This means a $10,000 investment could potentially earn around $750 per year in dividends, distributed monthly. RIET's portfolio is actively managed by Hoya Capital, selecting REITs across various property sectors. The expense ratio is 0.50%, higher than the previous ETFs, but many find this fee justifiable given the ETF's focus on high dividend yield and monthly payouts. Diversification is key, and while RIET offers exposure to a diversified portfolio of REITs, it's still concentrated in the real estate sector. If you're looking for a high-yield dividend ETF with a monthly payout schedule, RIET could be an excellent addition to your portfolio. For number 4 on our list, let's venture into the international market with the Franklin International Low Volatility High Dividend ETF, or LVHI. This ETF invests in high dividend-paying companies located outside the United States. It tracks the FTSE-developed ex-US Low Volatility High Dividend Index, selecting companies with a history of paying consistent and growing dividends. One primary benefit of LVHI is its international diversification. By investing in companies based in developed markets around the world, you're reducing your reliance on the US economy. This geographical diversification can help stabilize your portfolio's returns over time. LVHI also aims to provide a smoother ride by focusing on low volatility stocks. This means the ETF's price is expected to fluctuate less dramatically than the broader international market. Despite its focus on low volatility, LVHI offers a compelling dividend yield of around 4.1%. In terms of fees, LVHI has an expense ratio of 0.25%, which is reasonable for an international ETF. This means you'll be paying $25 per year for every $10,000 invested. Investing in international markets comes with its own set of risks, such as currency fluctuations and geopolitical events. However, for investors looking to diversify globally and generate passive income with lower volatility, LVHI is worth considering. Let's move on to our final ETF. Finally, rounding out our top 5, we have the VanEck Preferred Securities X Financials ETF, ticker symbol PFXF. This ETF focuses on preferred securities, a hybrid security that combines features of both stocks and bonds. Preferred stocks typically offer higher dividend yields compared to common stocks. PFXF focuses on preferred securities issued by companies outside the financial sector, aiming to reduce risk and volatility. By excluding financial companies, PFXF aims to provide a more stable and reliable stream of income. PFXF currently boasts an impressive dividend yield of around 5.7%. This means a $10,000 investment could potentially generate $570 per year in dividends. Preferred stocks come with their own set of risks, generally considered riskier than bonds but less risky than common stocks. PFXF's focus on non-financial preferred securities helps to mitigate some of this risk. In terms of fees, PFXF has an expense ratio of 0.40%, which is reasonable for an ETF focusing on a specialized asset class. If you're looking to add a high-yield income-generating asset to your portfolio, PFXF could be a valuable addition. Let's wrap things up. And there you have it, the top 5 best high-yield dividend ETFs for 2025. Investing in dividend ETFs can provide a steady income and help grow your wealth over time. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and insights. Also, let us know in the comments which ETF you're most excited about. Dividend ETFs collect dividends from the underlying stocks and distribute these payments to shareholders, usually on a monthly or quarterly basis. Always do your own research, consider your investment goals and risk tolerance, and consult with a qualified professional before making any investment decisions. Thanks for watching, and happy investing.